If you bought something in India in 2008, you watched the cashier do this, thumbing through stacks of paper, smoothing out crumpled edges, and carefully counting out weathered, taped-together rupees by hand. India was a country of over 1 billion people and the fifth largest economy on Earth. Its software engineers were building the backbone of Silicon Valley, yet 87% of all domestic transactions were still settled with physical paper. Digital payment networks existed, but they actively excluded small vendors. Setting up a card-swiping terminal cost a merchant thousands of rupees in fees. To compensate, shop owners used handwritten minimum purchase of 500 rupees signs, effectively barring everyday small-ticket purchases from the digital grid. This chart shows data published by the Reserve Bank of India in 2009. The average person in India made exactly 6 non-cash transactions a year. In the United Kingdom, that number was over 200. In the United States, it was over 300. The system was operating as designed. This was an architecture built to serve the internal needs of banks, rather than functioning as a utility for the general population. Sending money home to another state required the NEFT transfer system. This meant correctly typing out an exact multi-digit bank account number, followed by an alphanumeric branch code. A single typo meant the funds disappeared into a weeks-long recovery process. Speed was an additional barrier. Servers processed transfers in scheduled batches, and adding a new recipient required a mandatory multi-day cooling period before the system allowed a single rupee to move. For those in rural villages, receiving government welfare required a full day of travel. A farmer might walk 4 kilometers to the nearest bank branch, only to wait hours in lines like this, just to collect their payment in physical cash. These design hurdles created a structural trap. The people who most needed financial speed were forced to navigate the slowest, most labor-intensive corners of the economy. Finding a solution required moving away from the streets and stepping behind the gates of the Reserve Bank of India. In 2007, the Indian Parliament passed the Payment and Settlement Systems Act. This wasn't a flashy law, but it gave the central bank the legal authority to create a new kind of national payment infrastructure. In 2008, they established the National Payments Corporation of India, or NPCI. It was a non-profit umbrella organization designed to sit between public and private banks. 10 founding members, including the State Bank of India, ICICI, and HDFC, promoted the body. To lead it, they appointed a career banker named A.P. Hoda, who built the organization's operations from a single-employee startup. By making the NPCI a multi-bank nonprofit, the architects ensured the system would act as a public utility. Its objective was to move money efficiently for every bank and citizen, rather than generating profit through individual transaction fees. The long-term plan to connect this network to the population came from Nandan Nilekani. As the co-founder of Infosys, Nilekani entered government service in 2009, with a focus on solving large-scale social friction through technology. Nilekani observed that poverty was often maintained by a lack of verifiable identity. If you couldn't prove who you were, a bank wouldn't open an account for you, which meant you couldn't receive government payments or digital wages. His vision used 2 layers. A digital identity layer called Aadhaar would verify the user, and a digital payment layer built by NPCI would move the money. The Aadhaar system allowed millions of unbanked citizens to establish a formal identity by capturing biometric data, like fingerprints. This created a digital link between the physical person and the financial grid. On the payment side, NPCI launched the Immediate Payment Service, or IAMPS, in 2010. This allowed bank accounts to send and receive funds instantly, 24 hours a day, including holidays. It was designed to run on mobile phones, anticipating a future where most banking would happen on handheld devices instead of physical branches. However, IAMPS still required users to memorize 11-digit account numbers and complex codes. It provided the speed for instant transfers, but the interface remained too technical for a street vendor or an average consumer to use for small daily purchases. Even with these policy shifts in 2010, the reality on the street was unchanged. Physical currencies still settlement nearly every transaction in the country. Most of the population was unaware of Nilekani's vision or the existence of the NPCI. Yet the foundational layers of the economy had shifted. The legal framework was active, the neutral institution was operational, and millions of citizens were being enrolled into the digital identity layer. The institutional infrastructure was complete. But it still lacked a simplified interface that could replace the account numbers and codes of the old system. The design that would make these tools accessible to a tea stall owner was still 4 years away. The institutions were in place, the code was compiling, and the clock had officially started on a network that would soon displace physical paper for the majority of the population. November 8, 2016. At 8 o'clock in the evening, Prime Minister Modi appeared on national television to announce that from midnight, the 500 and 1,000 rupee notes would no longer be legal tender. The midnight decree instantly invalidated 86% of the country's physical currency. Every high-value note in every wallet, every cash register, and bank branch across the nation was suddenly reduced to worthless paper. Within hours, ATMs ran dry, bank queues stretched for hundreds of meters as citizens scrambled to deposit their savings before the December deadline, leaving small businesses unable to pay workers and supply chains frozen. This disruption exposed a massive structural vulnerability. A billion-person economy was almost entirely dependent on physical cash, and that dependency had just been severed. But while the public panicked over the lack of physical currency, a parallel financial reality was already in place. 6 months earlier, a digital payment architecture had launched to almost no public notice. It sat dormant, waiting for a reason to be used. As the search for a financial safe haven intensified, this invisible digital system was about to face a national stress test. The project began in 2012 when a committee led by Nandan Nilekani was tasked by the Reserve Bank of India with creating a radically accessible digital payment system. The engineers focused on a single conceptual goal, making the transfer of money as effortless as sending a text message. Their first breakthrough was the virtual payment address. Instead of a 16-digit account number, a user only needed a simple ID. It was also built for interoperability, allowing any app to talk to any other bank in real time. Rather than building a single government app, they used an open API model. The government provided the background infrastructure, allowing private fintech companies to build their own innovative interfaces on top of it. This system, the Unified Payments Interface, had its quiet pilot launch in April 2016 under RBI Governor Raghuram Rajan. The engineers had constructed a universal financial highway. Now they had 1 billion people who suddenly needed a way to use it. When the cash supply vanished in November, UPI became the only viable option for millions who had never previously considered digital payments. App downloads exploded. Payment servers saw massive influxes, recording a 250% surge within a single week. This chart captures the impact. Digital transaction volumes climbed 43% between November and December alone. Even after physical cash began to restabilize months later, these transaction volumes did not return to their pre-crisis levels. Demonetization functioned as a brutal, involuntary shock to the country's financial habits, forcing a rapid transition because there was no alternative. On the streets of Varanasi, Meena Devi sold flower garlands outside a temple. Her business ran entirely on cash. She had never owned a smartphone or a bank account. After the ban, her daily sales plummeted by 70%. The savings she kept in a tin at home were now invalid, and her regular customers had no physical notes to give her. To save the business, her daughter helped her open a government account and taped a printed QR code to her wooden part. A day later, a young customer scanned that piece of paper with a phone and paid 50 rupees for a garland. This 50 rupee transaction confirmed that the need for expensive merchant hardware had been bypassed. Anyone with a piece of paper and a smartphone could now participate in the digital economy. Meena Devi's income eventually surpassed its pre-crisis levels because customers no longer needed exact change to make a purchase. This shift occurred for street vendors, for auto rickshaw drivers, and millions of workers across India. These citizens were previously excluded, not by choice, but because the traditional banking system was not designed to handle microtransactions at this scale. While the cash ban invalidated paper currency overnight, it triggered a technological failsafe that successfully shifted the country's economic plumbing into digital code. In August 2025, a single payment network processed 20 billion transactions. That is 20 billion individual transfers perfectly completed within a span of just 31 days. They originated from the smartphones of billionaires looking over the Mumbai skyline and they were scanned off QR codes pasted to roadside stalls in rural Mizoram, all of them moving instantly across the exact same rails. To understand that volume, look at the legacy standard. Visa, operating globally since 1958, built an infrastructure handling about 639 million transactions a day. This chart compares daily transaction volumes. The blue bar represents Visa's global network. The second bar, which overtakes it at over 640 million a day, is India's homegrown UPI system. A free, government-built platform, less than 10 years old, is now processing more transactions than the largest corporate payment company on Earth. Scaling to that level was a deliberate act of unglamorous systems engineering. If you rewind to 2016, the average Indian had highly logical fears about putting their money on a screen. People worried about hackers, typing in the wrong number, or having their funds vanish into the ether. At the time, paying with a legacy plastic card meant handing a merchant your full account number, printed right on the front, with the security code sitting visibly on the back. Skimming and cloning were rampant. Before the engineers could push billions of transfers through the servers, they had to solve the psychology. They built a highly secure digital fortress, but disguised it as a frictionless mobile app. First is device binding. Your account permanently links to your physical smartphone, instantly rejecting unauthorized devices. Next, your custom PIN travels heavily encrypted straight to the bank, never touching merchant hardware. Together, this bound phone and memorized PIN create two-factor authentication. Behind the scenes, the network operates an active surveillance grid. It evaluates every transfer in real time, hunting for unusual geographic locations or rapid, high-value anomalies that look like social engineering fraud. By keeping the user's banking credentials entirely hidden from the merchant, this architecture became materially more secure than any physical card ever produced. Handling the volume of 1 billion people requires fault-tolerant infrastructure. To survive peak surges, like tens of thousands of simultaneous payments per second during Diwali, the backend relies on highly redundant data centers that seamlessly take over if one server fails. But the most elegant piece of the entire system has nothing to do with server racks. It is a printed piece of paper. Opting for the QR code bypassed the need for expensive card terminals. A printed code costs nothing. It requires no electricity, doesn't need software updates, and it never breaks down. The engineers pushed that accessibility even further for users without internet. They built a USSD-based offline mode that allows anyone with a basic feature phone to transfer money using standard cellular signals. They also developed Voice-C, an audio layer allowing visually impaired and elderly users to authorize payments using simple voice commands in regional languages. The architects operated under a strict dual mandate. By refusing to compromise on the highest-end technical sophistication or the lowest-end physical accessibility, they created a system that works for literally everyone. On February 2, 2024, a tourist from Hyderabad stood at the ticket counter of the Eiffel Tower in Paris. She opened an app on her phone to pay for her admission. She scanned a QR code and entered her PIN. Within seconds, her transaction was approved in euros, converted instantly, and deducted directly from her local Indian bank account, with no foreign exchange friction. In 2012, 87% of transactions in India were conducted in physical cash. Today, the Unified Payments Interface, UPI, handles 84% of digital payments. The Paris transaction proved NPCI's engineering could scale globally, operating as a functional utility far beyond its borders. The Paris transaction demonstrated that India's digital public infrastructure could resolve the universal friction of moving money between different currencies and banking systems. Global expansion began in July 2021, when Bhutan integrated the framework. Instantly, Indian workers and tourists crossing into the kingdom no longer needed to exchange physical currency or pay international transaction fees. They simply scanned and paid. By February 2023, the scope increased. The Prime Ministers of India and Singapore jointly initiated a direct linkage between UPI and Singapore's PayNow network. This created the first true cross-border, real-time payment corridor. It allowed Indian workers in Singapore to execute zero-fee remittances, sending their salaries directly to their families in seconds. Integrations followed across the UAE, allowing tourists to pay for goods at the Dubai Mall. Within the following year, Sri Lanka, Mauritius, and France joined the network. This technology is now moving beyond mere acceptance. Nations like Peru, Namibia, and Trinidad and Tobago are currently using technical assistance from Indian engineers to construct their own independent, sovereign versions of the network. With 20 countries targeted for integration by 2029, foreign governments are increasingly choosing to build on India's open-source architecture instead of relying on traditional, fee-based financial networks. Traditional financial centers have responded to these developments. When the United States Federal Reserve launched its real-time payment system, FedNow, in 2023, American regulators cited India's UPI as a primary model. The International Monetary Fund and the World Bank have officially endorsed this ecosystem as a definitive model for financial inclusion in the developing world. The NPCI measures its success by the displacement of physical cash. While legacy corporate processors compete for market share, India's digital ecosystem focuses solely on making paper currency obsolete. This chart highlights the scale of that shift. The network processes 640 million transactions every day, while maintaining a fraud rate of less than 0.002%. To maintain this rate, the 2023 Telecom Act allows carriers to feed flagged numbers into the payment database. AI-based monitoring identifies fraud patterns in real time, allowing banks to freeze suspicious accounts before a transfer is completed. By synchronizing telecom data with banking infrastructure and machine learning, India has made digital transfers empirically safer than handling paper banknotes. This massive shift was driven by a foundational vision from Nandan Nilekani. He recognized that connecting the Aadhaar digital identity stack directly to a universal payment layer would allow instant, verifiable transactions across the entire country. The Reserve Bank of India provided the institutional mandate. Under governors like Raghuram Rajan and Shaktikanta Das, the central bank transformed the concept into a national standard. The execution relied on ground-level adoption. UX designers simplified complex bank routing for first-time smartphone owners, while bank correspondents in rural villages acted as digital payment agents. The system reached its current volume because millions of individuals chose to integrate the QR code into their daily routines, from auto rickshaw drivers to local street-side vendors.